The median life insurance benefit through your job is just $20,000 or about 1 year's salary, according to LIMRA. And more than half of workers who only have that coverage genuinely believe it's enough for their family. I read the fine print, so you don't have to. By the end of this, you'll understand exactly why that number is dangerously small and what the brochure never spells out. Here's the simple version. Life insurance through work is a group term policy your employer typically pays for, giving you a flat amount or roughly 1 times your salary. But that's where the simplicity ends. Think of it like the free umbrella a hotel hands you, fine for a drizzle, useless in an actual storm. The whole thing was built to cover funeral costs and short-term bills, not to replace years of a lost income. The way group coverage works is that your whole company gets bundled into one plan, and the employer picks a single flat benefit level for everyone, usually $20,000 to $50,000, or one-time salary, according to LIMRA and Insurance Newsnet. Think of it like a company vending machine. Everybody gets the same snack whether they're starving or just peckish. That's why the amount rarely matches what your specific household would actually need. Now, here's the benchmark almost nobody hears about. Financial professionals commonly recommend coverage of 10 to 12 times your annual income, according to Guardian and Insurance Newsnet, with some age-based guidance going as high as 30 times salary. Think of it like a bridge. It has to reach all the way to the other side, or it doesn't do the one job it exists for. Coverage is supposed to replace years of income, pay off debt, and fund your kids' futures. So let's put the two numbers side by side. Someone earning $80,000 a year with one-time salary through work has $80,000 of coverage. But the 10 times benchmark says they need $800,000, leaving a gap of $720,000, based on figures from Guardian and Insurance Newsnet. Think of it like filling a bathtub with a teaspoon. You're adding water, sure, but you're nowhere near the level you actually need. This is where the math gets scary. LIMRA's 2025 research, reported by Insurance Newsnet, found that 49% of households relying only on employer coverage would face financial difficulty within 6 months of losing the primary earner. Think of it like a phone at 5% battery. It's working right now, but it will not get you through the day. A $170,000 payout against $60,000 a year of expenses is gone in under 3 years. Mortgage still unpaid. It's also getting harder to rely on. Fidelity Life reports that the share of adults with employer group coverage fell from 60% to 45% over roughly a decade, and life insurance ownership among low and moderate income families dropped 25% over 10 years. Think of it like a shrinking safety net under a tightrope. It's still there, but with more and more holes to fall through. If this is useful, subscribe. The next breakdown is already coming. Before I get to the last part, which is the most counterintuitive piece of this, here's the catch the brochure buries. Your coverage is tied to your job. Western and Southern notes there's no guarantee you can keep it if you leave. And ABC 15 confirms coverage typically ends when you leave the job. Think of it like a rental car. Great while you're driving, but the moment your trip ends, it isn't yours anymore. And here's the truly backwards part. The coverage tends to vanish at the exact worst moment. Picture a 45-year-old earning $90,000 with 2 times salary through work, $180,000. A layoff wipes it to zero, right when age or health issues make new private coverage expensive or unavailable, versus the $900,000 to over $1 million, a 10 to 12 times benchmark suggests. Think of it like an umbrella that folds itself up the second it starts to rain. So what does this mean for you? Tonight, pull up your benefits portal and write down your total work coverage, basic plus supplemental. Then multiply your income by 10 and 12 to get your target range per Guardian and Insurance Newsnet, and subtract what you have. Think of it like weighing your luggage before the airport. Far better to know now than at the counter. That single number is your coverage gap. The smart move isn't to ditch your work coverage. It's to layer on top of it. Insurance Newsnet describes using workplace insurance as a short-term liquidity fund, then adding an individual term policy to reach 10 times your income. Think of it like layering clothes. The work policy is your t-shirt, and your own term policy is the coat that actually keeps you warm. Because an individual policy is yours, a layoff can't touch it. The coverage your job hands you is a starting point, not a finish line. Check your gap and check whether it's portable before life forces the question. Next, I'm breaking down term versus whole life insurance and which one actually fits most families. If you want to catch that, subscribe so you don't miss it.